Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're very, very well and you're keeping warm. It's certainly turned distinctly more chilly, hasn't it, in the last few days. Another week closer to Christmas, another week where I have done zero Christmas shopping. I haven't ordered any foods. I have Christmas decorations up. I think I'm going for a last minute sprint this year towards the Christmas finishing line. Not sure about you guys. In terms of what we got for you this week, we're going to do our usual roundup on lender pricing changes, talk a bit about what's been happening with swap rates. We're then going to go through the latest Hamptons house price forecast, which is really interesting because they're not only sharing their predictions on house prices into 2024, but as far out as 2026. For those of you who are thinking about buying or indeed actually selling, this information could be really, really useful. We're then going to talk about the Leasehold and Reform Bill, what's been going on there and what it actually means. And then finally, we're going to be wrapping up with our usual feature question of the week. Okay, so swap rates. Last week, I was really hoping that I was going to be coming to you this week, telling you that 5-year swaps were under 4%. Not our week again, guys. Sadly, actually, last week, swap rates spiked after we'd released or videoed this investor update. So we'd seen an increase in pricing. They have eased back down a bit now. So actually, we've ended up slightly higher week on week on 5 and 2-year swaps than last week, which is slightly disappointing. So where are we now? So 2-year swap rates, 4.731%, 1 month ago 4.901, so circa 0.2% down month on month. 5-year swaps 4.178, 1 month ago 4.465, so circa 0.3% lower month on month. But like I say, slightly up on last week. Actually, that's what I would say here is the swap rates bubbled up towards the back end of last week, were relatively inflated yesterday and then started easing back down yesterday afternoon. So actually it could be that whatever kind of little hiccup or nervousness had hit the capital markets has eased again, and we might see swap rates continue to start coming down again. But that's what's been happening in the last week. Now, in terms of lender pricing changes, we have still seen some rates coming down. I don't think this is lenders saying, oh, swap rates have increased, so our cost of funds have increased, we don't care, we're still going to drop our rates. I think that largely these rates were probably curated prior to the swap rates increasing, because as we mentioned in previous weeks, lenders releasing new products is not a kind of instant thing. It has to go through a series of steps internally for these guys before they come out. So what we have seen in the last week is, first of all, the Mortgage Works make some reductions to their HMO and limited company offerings. So limited company rates now from 4.89%, which is pretty solid, if I'm honest with you, and HMO rates from 5.54. The Mortgage Works, I mean, they're a brilliant lender. They're the largest buy-to lender in the UK. They do seem to have something for most people, but they're very systems-led in terms of their underwriting approach. So you kind of have to fit the boxes to borrow money with these guys. So in terms of their limited company offering, the rates are really, really good. The downside with the Mortgage Works, their new limited companies, as far as I see it, the biggest kind of issue is that they will only lend where there are 2 applicants on the application form. So you can only have a maximum of 2 directors and shareholders. So say, for example, you had a limited company where you had 2 directors and 4 shareholders, you simply couldn't take a mortgage with the Mortgage Works. I know they're looking to review this, but this is kind of where they are at the moment. In terms of their HMO offering, it's very kind of light touch HMO, so maximum of 6 rooms being the key thing here, so nothing too racy. But like I say, if you kind of can meet those sort of boxes, then the rates are very good indeed. Now, we've also seen BM Solutions make reductions of their rates of up to 0.25%. Now, broadly speaking, in the kind of very vanilla end of the market, so people borrowing, rather than companies borrowing against very straightforward properties, BM Solutions do tend to be coming up largely tops in terms of rates at the moment. So their 5-year fixed rate from 4.46 with a roughly £4,000 fee. Now, the good thing with BM Solutions is you do get free valuations and either free legal work, or they'll give you a cash contribution of, I think it's £300 towards your conveyancing. So a really, really solid offering. Now, with BM Solutions, it's a maximum of 10 buy-to-let properties across all sort of ownership structures, so personal names and limited company. Very, very big on clean credit. Again, it's very much systems-based decisioning with these guys, who you either fit or you do not. The good news is that because of that, because systems are kind of processing a large chunk of their applications, it means that things do go through very, very quickly indeed. And that, combined with their very good pricing, means they've got a really solid offering at the moment. Now, Paragon have made some rate reductions of up to 0.4% in the last week. And what they've also done is released some semi-exclusive products which are available to us and also some other brokers as well, who obviously I'm not going to name. Now the pricing here, so 2-year fixed rates for Paragon are now from 4.19%, 5-year rates from 4.59%. Now in terms of the exclusive kind of element to this, so Paragon always offer a free valuation, but what they also do is charge an application fee of £299. So if you were to come via us, for certain products with Paragon, that £299 is actually waived. So you get essentially a saving of £300, which is really nice. So thank you to Paragon for giving us access to that. We do appreciate it. What else have we seen? We've seen West One bring down rates by 0.2%. So those are now from 4.19. We've seen Foundation Home Loans make reductions of up to 0.3%. So their rates are now from 5.69%. We've seen Lend Invest bring out some new rates. So 2-year fixes are from 3.99 and 5 years from 5.19. And we've also seen Principality make cuts to their rates of up to 0.15%. So another busy week from the lenders. Will we see the same number of rates coming down next week? I'm not sure we will actually, because of the swap rates bouncing around a little bit. We may not see quite so many pricing changes while lenders kind of wait to see how those numbers settle down a bit. But for now, another busy repricing week. Hamptons house price forecast time. So this is both a wonderful report and an absolutely enormous report, which I can't go through in detail because, quite frankly, there's only so long you're going to be able to tolerate staring at me on a screen for. What I would really encourage you to do is go onto the Hamptons website and find this and have a read yourself. It is so interesting. However, if you're struggling to find the link, or quite frankly, you don't want to sort of seek it out yourselves, just send us an email and we'll just ping it over to you. It's no problem. But a really good report. Do have a look. But what I've tried to do is kind of condense this and just share with you the key takeaways. So without further ado, the first thing that Hamptons have said is that year on year in 2023, house prices are going to be down by circa 5%. We know this isn't new. So let's start looking forwards now. So in 2024, what they're saying is essentially mortgage rates are going to be the primary driver of price performance next year. Based on the Bank of England's latest economic forecasts, which are grounds for optimism, inflation is slowing, the UK should avoid economic recession, unemployment is projected to tick up a little bit but still remain at historically low levels. And as such, actually, the Bank of England are now really turning their attention to wage growth, which is running hot. And this suggests that inflationary pressures have become embedded and that the tight labour market is enabling higher wage demands. Now, if this is the case and this kind of runs into next year, then essentially base rate is going to have to stay longer than maybe stay where it is for longer than people had initially thought, which is why I probably saw Andrew Bailey making reference to base rate staying high into 2025. Now, on this basis, and this is what Hamptons are kind of expecting to be the case, what they're saying is that they're expecting house price growth to be at 0% in 2024. So not a decline, although obviously comparatively, because we've had decline this year, there would still be a negative position, but actually with it won't be falling any further. Now, the next thing they do go on to talk about is a general election, which I do think is worth mentioning actually, because we know this is coming up probably next year, maybe into the new year 25. But what they're saying, which I found really fascinating, is that because both key parties, Labour and the Conservative Party, when it comes to properties and home ownership, are really taking a very central sort of ground on this, they don't really think that either party is going to have a huge amount of impact on the housing market. Now, what they do say is that actually, and this is just something kind of obviously really caught my attention, and that they are discerning signs that both parties are more aware of the role that private landlords play in the rental market, and this could lower the risk of more buy-to-let regulation. I mean, hallelujah to that, right? But essentially, from a kind of housing market perspective, they're fairly agnostic as to either party coming and how it will impact things. That's not to be confused with the impact of being a landlord, which is obviously a kind of very important add-on to that, which is a whole separate video in itself. So moving on to 2025, so what they're essentially saying is that a new recovery mode, a new housing cycle will be beginning. So after 2 years of real-term house price falls, we expect prices to return to growth in 2025. Further rate cuts should provide a stimulus, with the Bank of England eager to prevent inflation undershooting its 2% target. So by the end of 2025, the bank forecasts that inflation will fall back to 1.5%. Which it doesn't really want. Where we want inflation to be is just at 2% or thereabouts. So with financial markets expecting base rate to settle at around 4.6, there you go. These conditions mean that the average cost of a 2-year fixed rate mortgage could fall to just below 2%. Against this backdrop, Hamptons expect house prices to rise by 3% across Great Britain by the end of 2025. So there you go, that's the expectation for 25 growth that year. And then we fast forward to 2026, where they think that actually what we'll see is that interest rates will have reached a new normal, and this will fuel price growth of 5% in 2026 across Great Britain by the final quarter of the year, with London leading the pack with an increase of 7.5%. So there you go, hopefully that's helpful if you are thinking about, like I say, not just buying, but also selling and considering your options. This will give you a kind of view where at least Hamptons expect prices to go over the next few years. Now, in the last couple of days, the Leasehold and Freehold Reform Bill has had its first reading in the House of Commons. So why is this important? So there are around 4.98 million leasehold homes in England. 30% of these are houses and 70% of these are flats. So this affects essentially millions and millions of property owners. So the main points of the bill are an increase in the standard lease extension from 90 years or 50 years in flats to 990 years. Greater transparency over service charges by making freeholders or managing agents issue bills in a standardised format that is clearer and easier to challenge. Making it easier and cheaper for leaseholders to take over the management of their properties. Scrapping the presumption that leaseholders pay their freeholders' legal costs when challenging poor practice. Banning opaque and excessive buildings insurance commissions for freeholders and managing agents, and removing the requirement for a new leaseholder to have owned their house or flat for 2 years before they can extend their lease or buy their freehold. So actually, some really, really great stuff in there. I think this particular bill has been kind of overshadowed by the Renters Reform Bill, particularly, in our world at least. So we'll keep you updated on that, but it's had its first reading in the House of Commons, so we expect some more news to be available on this in the very near future. And finishing off with question of the week. So this one is an absolute cracker actually, and one of our clients asked us this in the last few days, and I thought this was definitely one to share. So the question is, what is the difference between a bricks and mortar valuation and an investment valuation? Now, we normally come across this question in the context of people who are buying or refinancing either an HMO or a block of flats. And it comes up fairly often actually. So a bricks and mortar valuation, which is just also known as a vacant possession valuation, is essentially what your property is worth if it were to be sold on as a normal property, so to be sold on as a family home, for example. So the kind of valuation that we all just kind of expect. An investment valuation is where the property is valued based on its income it's going to generate rather than its resale value. So it's often a yield-based calculation, and the key reason people often seek this is because it can end up with a higher valuation than the bricks and mortar counterpart. So if a property is a 10-bedroom HMO in Hull and it's generating a yield of circa 12%, that property is going to be worth more as an investment, as a going concern, as a business essentially, than it is as if it were sold on as a kind of just a standard building. So in terms of getting a commercial valuation, investment valuation on property, it's not necessarily straightforward. There are a few things you need to be kind of mindful of if you are thinking about trying to go down this pathway. So the first thing is that not all lenders will offer investment valuations on properties. So you kind of need to pick those lenders who are going to be looking at larger HMOs, multi-unit properties. So people like, for example, Shawbrook, Interbay, Keystone can consider it, Paragon may put in some investment valuation into the larger properties. But if you go to someone like BM Solutions, who only lends on smaller houses and standard flats, they're simply never going to offer an investment valuation at all. So picking the lender is the first thing. Now, in terms of whether you actually get an investment valuation, so in our experience, it tends to be available for larger HMOs and multi-units. So broadly speaking, between 6 and 8 rooms or units or above. And the reason for this largely comes down to resale. So how is the property likely to be resold in the event of a repossession? So if I've got a 4-bedroom HMO, which is in a row of houses which are all occupied by families, it's very, very quiet and peaceful, and that property were to be repossessed and sold on, the reality is that the people who are going to buy that property is probably going to be a family rather than an investor. So that kind of means that property is unlikely to be eligible for an investment valuation. If I had a 15-bedroom HMO slap bang in the middle of Fallowfield in Manchester, which for those of you who don't know is a really big student area. The reality is that if that property were to be sold on, it's unlikely to be sold to a family, because a family probably wouldn't want a 15-bedroom property with 15 en suites, and secondly they probably wouldn't live in a very kind of strong student area as well. So this property would be more likely to attract an investment valuation than the 4-bedroom property. Other things that can be considered within this, so the size of the property, the location, it can be whether the property has had any kind of change of classification, so for example whether it's sui generis and whether it's licensed. I mean, there's lots that go into this, but I hope at least that answers the kind of basic question of what the difference is between the two and why somebody would want one. And that is everything from me this week. Thank you as always for joining us. I do hope you found that helpful. And as always, if you do have a question of the week question, please just leave it in the comments below, or if you're a little bit shy and you don't fancy doing that, you can just email us in. But as always, we would love to be answering questions that are important to you, the people who do invest your time in actually watching the video. So please send them along. For now, have a lovely week. Do enjoy the sunshine. It's actually in my eye at the moment. I shouldn't moan because it'll be raining tomorrow, I'm sure. And if you do have any questions, you can always give us a call, 0345 345 6788, and the website is open 24 hours a day, 7 days a week, if you fancy having a nose around on there. Enjoy your Christmas preparations, and I will see you again same time next week.